guys, thank you for taking the time. I know you guys are busy to watch this quick video. My name is Scott Kleist. I'm with EXP Realty. I do sales in the West Coast, the East Coast, focus a lot in the Orange County area, as well as Wake County, Raleigh, Durham. And, I wanted to take a moment to introduce you to my good friend, Dave Herbst over at CMG Financial. He is the innovator, pioneer, leading the charge on a product that you guys absolutely have to know about. The 30-year fixed mortgage has literally been around for like over 80 years, you guys. So it's about time this industry is bringing some much needed innovation that helps people pay off their home faster, really accelerate the wealth building creation aspect of real estate, which is really what I do. I happen to sell homes, but I like to help people build generational wealth through the art of purchasing, investing, selling real estate. And so that's what we're here to do. We're going to make this as short and sweet as possible. And so without further ado, I wanted to ask Dave to, let us know who is CMG and why is, what's going on that makes you guys so different out there?
Sure. Yeah. Scott, thank you so much for including me in this. I know that your audience are people that are probably thirsty for new information. And that's exactly what you do is you bring new information, new ideas, and you expose innovation to the people that you serve. So I appreciate the opportunity to join you and participate with that journey. So CMG Financial, as you know, is a nationwide lender. We are family owned and operated. We've been in business for nearly 29 years now, and we think differently. I know that's probably kind of a hard to believe. I think for the most part, most consumers look at the mortgage industry as a sort of a bowl of oranges. We're fungible. You really can't tell one orange from the other. You really can't tell one lender from the other. I understand that, and why. But the truth is that CMG Financial thinks differently. Being privately held allows us to be very agile and pioneers. And of course, we're here to talk about the program called the All-in-One Loan, which really represents finally some innovation out of the industry, shrinks the cost of a mortgage so that puts people in a better financial position. Glad to be with you. I've been with the company for 17 years and I manage this program nationwide. So this is what I do for a living and I love it.
Awesome. So one of the first things that you just said, you've been in this with CMG for 17 years. How long has this innovative program just been around for? You developing it real quick?
Yeah, we pioneered this in 2005, so 16 years ago. 16 years ago. It really is based on a concept that has existed for decades in other countries. Mm-hmm. So we're not the first to think of it. We were exposed to it back in 2002, and we fell in love with the concept, just understanding that it'd benefit the American homeowner and home buyer dramatically shift their life in a very meaningful way financially and create a lot of security and flexibility and control that you just do not get with mortgages. Scott, as you know, that most home buyers need to borrow money to make that purchase possible. And most homeowners out there need to continue to pay on a mortgage in order to possess real estate. Unfortunately, mortgages are a huge impediment to that process. It slows down or delays the journey of owning a home or building equity in your home. It also creates a lot of constriction because mortgages aren't fluid. They're not liquid tools. Back in 2002, we fell in love with this idea that other countries utilize as a mainstream mortgage product. Canada, throughout Western Europe, New Zealand, Australia, India. Most of the world's largest banks and active real estate markets actually have this loan available. We're just so slow to change here in America, but this represents that change now.
I love it. And I know this program is so good for buyers. It's probably not your most profitable loan. Is that true? I mean,
no, it's not. You're absolutely right. Yeah, great point. It reduces the cost of the mortgage itself. The interest you have to pay, it reduces your exposure to it, and it does it automatically, naturally, comfortably, safely. We can go into those details here in just a moment. But you're right. There's less interest actually yielded or earned on this mortgage by us versus a conventional mortgage. One of the reasons why that is because a conventional mortgage collects the interest cost up front. In fact, about 50% of the total interest you pay on a 30-year fixed is going to be paid for in the first 10 years alone. The all-in-one loan is the only truly principal paid first mortgage product in America. So it reduces your balance faster. Therefore, you spend less money on interest costs. But what it does for us is it creates a stickier relationship. We don't lose customers to refinances routinely like we would on a 30-year loan. We of course offer all those other products, 30-year fixes, 15-year fixes, FHA loans, VA loans, all those other, products. And they all have their place, right? And time for a customer. There shouldn't be a one size fits all solution. Of course not. And that's one of the reasons why we developed out the all-in-one loan for a specific type of person who wants to get ahead and is able to get ahead financially and set some goals, be a little bit disciplined. It's a dramatic shift in the way the mortgage works and what it does for you.
Hey, that's a perfect lead in, Dave. So when I'm looking out, so I sell real estate, right? And so real estate and finance are inextricably intertwined. They're both asset classes, essentially, right? There's current money. And so you can't really separate those two things. So as I'm out there in the world talking to my, homeowners, who makes a really good candidate for this and why? And who might not be the best candidate for this innovative program that might be a better fit for more traditional financing? More traditional
financing. Yeah, great question. The most suitable candidate for the all-in-one loan is a borrower or household that lives within their means. It's really where it begins. Are you somebody that lives paycheck to paycheck and in fact potentially even leverages credit to supplement your live-in expenses because you just don't really have a grip on your finances? Then a more traditional mortgage product, a very long-term, amortized traditional mortgage product would be more suitable potentially for that person. The all-in-one loan is extremely powerful for the household that lives within their means, meaning that they spend less than they make on a routine basis. And as well as I do, Scott, right? There's spikes and valleys or peaks and valleys in our spending behavior. Christmas is expensive. Vacation time and during the summer is expensive. You tend to spend more money during those periods of time. But overall, on an annualized basis, if you're cash flow positive, you tend to spend less than you make annually. This is a phenomenal program. And of course, we tend to also want to look for those that have sustained or maintained good credit standing, have obviously demonstrated the ability to repay debts, along the way. The only other requirement is that you know how to use a checking account. I'm going to give you a little teaser there, right, before we get into the dynamics of how it's structured. But do you know how to use a checking account? Well, that's one of the qualifying aspects of the loan.
I'll tell you one thing. Every single one of my clients know how to use a checking account. So I think
I would guarantee. Yes. Yeah. I would guarantee that 100% of mortgage borrowers know how to use a checking account and use one, on a routine basis. So it's a no-brainer.
Absolutely. Well, cool. Sorry about that, guys. So now you've been doing this for a while. You guys have obviously had many, many experiences and had a lot of real life, scenarios. Why don't you tell us a little about what could be achieved, because this, loan products, you don't walk into a house and say, what a beautiful mortgage this is, unlike, the beautiful staircase that you had your handyman helping you, whatever. So this is like this intangible thing that has very tangible results. And so why don't you tell us a little bit more about what some of the experiences are, your clients have actually been able to use this amazing product for?
Yeah, absolutely. And I'll tell you, I think one thing that you do notice when you walk into somebody's house is how relaxed somebody might be, right? Financially, you can tell when people are stressed and when they're not stressed. And I can tell you that this creates a lot of security, a lot more control of your finances and your costs associated with your housing debt. So the all-in-one loan as a concept merges your mortgage with your personal checking account. That's it. It's so simple. Why does that make sense? Here's the reality. Most people in America will earn and flow and manage more money through a checking account in just the course of 5 years than they actually owe on their mortgage. So why does it take us 30, 40, 50, 60 years to pay down a mortgage? It's because your money is kept separate, your powerful income dollars. I'm talking about your idle money, the idle cash you have on hand right this moment. Everybody has some because you have a cell phone bill that may be due in 2 weeks, or you have grocery shopping coming up that you want to accomplish this coming weekend, but you haven't spent those dollars yet. So most of us have idle cash sitting in a checking account, doing nothing for us, earning us near 0% interest, right? Because banks don't want to pay us any money. No. So in the meantime, we have this mortgage and it may have a low interest rate, but it doesn't cost you low amounts of interest. It costs you a tremendous amount of interest, even with a low interest rate. And that's because the way that your money is applied to it is engineered to benefit the bank first and not us first, the consumer, the homeowner. So we changed that entirely by merging the checking account with the mortgage. So the all-in-one loan is a mortgage that you flow your income in and out of. You literally deposit cash into,
Wow.
Let it sit there. And by doing so, Scott, it reduces your daily principal balance. And that reduction of your balance now reduces your interest cost that month. And you're free to use it. So this mortgage comes with ATM debit, Visa cards, check writing, online banking, online bill pay. You could ACH transfer money anywhere. You can write checks freely. You can do mobile deposits and do mobile banking, use Venmo. Your cash, your idle money, your deposits sit in your mortgage, keeping your balance lower, which keeps your daily and monthly and annual and total interest costs lower. Less interest spent on a mortgage means you're out of debt sooner. You build equity faster. But here's the real key thing that leads to a lot of success. All that money is kept liquid. You have access to all that money and you have access to your home's equity dollars over 30 years, 24/7, without ever having to refinance again. So it just creates this unmatched level of control and flexibility and security for people because you reduce the size of your debt faster and save a tremendous amount of money. What can be achieved? Gosh, the average homeowner with the all-in-one loan pays down their balance at a pace of about 13% per year. Imagine your balance being eliminated 13% per year. That's about it's about a 7-8 year payoff on average, right? And that money's liquid. So what it also does is it creates opportunity for you to invest more aggressively sooner in your life. If mortgage payoff and home ownership and having a free and clear property isn't necessarily your near-term goal, that's fine. You could still save a ton of money and a ton of time and be liquid and use your money, your resources in better ways than paying mortgage interest. Maybe invest in another property, buy a second home, buy up, renovate the property you're currently in. Yeah, buy business.
Buy a business, more money machine.
Exactly.
Absolutely.
Exactly. Basically, the overall concept is if homeowners had more of their money left in their possession, they would have more opportunity to build wealth with. It's just that simple. And the mortgage is the biggest impediment to all that. And we fix it using the all-in-one loan.
So essentially, from my financial hat on, essentially we're diverting money off of the P&L, which is an expense called interest. We're moving that interest and we're shifting it over to the balance sheet on assets, which then we could use to buy other assets and other investments.
That's it. Yeah. So saved income, right? Money not spent on interest cost. If kept in the all-in-one loan, continues to compound your savings as an investment. You're effectively using your idle cash to save interest cost at the rate of the loan itself, right? Which is competitive, but you're now yielding a better result with your cash than you could, in the all-in-one, than you could earn if you manage that cash through a traditional checking account, right? Checking accounts pay zero. So why don't you put your cash flow in your mortgage, saving mortgage interest at the rate of the loan, and you could take those savings and now utilize them, to your point, to build wealth sooner and faster, more aggressively in other areas like buying additional real estate or a business or something else that you want to achieve.
So it's almost like a checking account and a savings account in a way, because my idle money that's in there during the month, as it goes in, money comes in and goes out, it's canceling interest because interest calculates daily, correct? And then
that's correct.
At the end of the month, if I have 3,000, 4,000, whatever my disposable income is that's left over that I would have traditionally maybe put most of that in my 401 or into a CD or IRA, that money can just literally offset interest on the balance. But then just like a savings account, it's liquid. So it's not illiquid. It's actually better than a CD because CDs usually have 6 months, some kind of time commitment.
Maturity date. Yeah, exactly. Yeah. Limitation on access. You're dead on. Yeah. It's like investing your cash. Here's the other thing that if you want to take it a little bit deeper, it also protects your cash from inflation. I mean, inflation is one of those things that is obviously in the headlines today. Inflation is not new. We've seen inflation. It's one of those constants that are behind the curtain, and it's constantly impacting your buying power as a consumer in America. And every single day, your cash is sitting in your savings account, a CD, a checking account. It's always at risk of losing value. So in the best of worlds, what you want to do is you want to put those dollars into something that protects them. But also what's beautiful about the all-in-one loan is it not only shelters your money from inflation, but it also reduces the expense of your mortgage all at the same time while keeping it safely and securely liquid for you to use.
Let that one set in, guys. Whoa. A lot.
It's a powerful thing. It's so simple. Yeah, it's a mouthful and it's a lot to think about. It's a paradigm shift, Scott, but here's the bottom line. Most Americans owe a mortgage out there that are homeowners, about 58 million households today, right? And buyers need a mortgage in order to make that purchase possible. The collective sum of mortgage debt that exists today is approaching $11 trillion on just our homes. Nobody in the media is talking about that. Nobody. It's time for innovation. It's time that the mortgage innovates, as you put it early on in our discussion. The mortgage, as we know it today, was invented during the Great Depression era. It's time for a change. We need to work hard to help people get ahead sooner in their life, especially as homeowners.
So going from what some all-in-one customers have actually used this product for, we talked about investing in other businesses, maybe pay for college education, maybe, buy other real estate, rental property. All of a sudden, if you have extra equity, you can do that 25% down and get the best rates on a purchase, which, we'll talk about it. I think we might be able to even use this exact product on an investment property, guys. We're going to get a little bit in just a second. And then ultimately it's just a security blanket. Like you said, like people could sleep better at night because they know they have this thing called sleep insurance where you have all this equity, but this time it's actually liquid. You can pull it out anytime you want. And that's got to be comforting to your customers to know that they have access to the equity. I mean, especially in the last couple of years, Dave, as you know, the market's been so vibrant, so amazing. There's been so much equity just created out of thin air. That's how, appreciation works over time. And all that equity, people are sitting on it, but it's a travesty. Sometimes maybe someone loses a job. What do? Well, if you have a bunch of equity, you have enough liquid assets to be able to ride the storm out. And so that's what I really love about this, giving my clients, our mutual clients, the most access to their money. Because when homeowners have access to money and liquidity, guess what? They can make good decisions. They know how not to lose their house. They know how to keep their bills paid. But it's when that illiquidity happens, at some level, the more illiquid equity you have in your property, the more at risk you are of having a hiccup in your life.
100%. 100%. I think one of the things that is not exposed enough is how risky the traditional mortgage is. We all tend to think that the 30-year fixed, fixing in your rate and getting, and just maintaining your managing your mortgage debt using the standard mortgages. We tend to think that that's, the less risky way to go. It's become the gold standard in America. We've all become programmed to believe that that's the best way to manage real estate. It's not. The one thing that we know for certain is that there's uncertainty around the corner, right? We know that. Look at the pandemic, look at the 2008 financial crisis. There's probably another thing that's headed our way in the next 5 or 10 years that's going to have some sort of offer some sort of challenge, right, to each and every single household financially, some doubt, some concern, and potentially even job loss or income reduction. We've had this loan now since 2005. So we still to date have no delinquencies, no defaults on this loan. Why? That's because it provides access to your home's equity dollars without having to refinance, without having to ask somebody. It's your money. If there is job loss, which a lot of our customers have experienced, you have access to your home's equity, your wealth that you gain over time through principal reduction. And you can access those dollars right back out, right? And live off them, get back on your feet, get back going without having to worry about losing your home or foreclosing or defaulting on a mortgage, and staying current. So your credit standing continues to improve. Yeah. So it's just it offers, like you said, that security blanket and a lot of opportunity. You're right. This could be used for purchase. It could be used for refinance. We can use it to finance a primary residence, a second home, as well as an investment property. So it's a phenomenal product for those that want to go buy investment properties, add real estate to their portfolio, because it does a couple things. As a real estate investor, right, and somebody that's managing rental properties. Of course, you want to continue to grow the positive cash flow out of those properties each and every single month. Well, there's only one way, or actually two ways, really, to achieve that traditionally. One is to refinance and lower your payment, right? So you create a little bit of room between the rents you're receiving versus the mortgage obligation on a monthly basis. You can't always rely on that because mortgage rates don't always cooperate with that idea, right? Sometimes mortgage rates come down, sometimes they go up, and it's costly to sit there and refinance over and over and over again and chase interest rates down. That's cumbersome, it's expensive, and it's not always attainable. The second way to increase your cash flow is to increase rents. I can tell you, as a real estate investor myself, that's not always possible. You can scare away a very loyal, very good renter, right? And some business opportunity just by increasing your rents. You don't want to price yourself out of the market. You want to maintain, good relationships and stay competitive. On the all-in-one loan though, because it's reducing your monthly interest payments, it's principal paid first, Interest calculating nightly, paid for in arrears. The interest payment's a separate event. You pay for that after each month ends based on your banking behavior throughout the month. So as you use this, imagine taking your rental income, depositing it directly into your all-in-one loan mortgage. Your mortgage balance drops by an equal amount that day. Therefore, interest is saved that month. Imagine doing that every month. Now your interest payments are reducing ongoingly month over month, which means you're growing your positive cash flow in the property without having to rely on refinancing, without having to increase rents. It does it for you automatically. It's an awesome product to grow wealth, grow positive cash flow, continue to build on your real estate portfolio, and just live a lot more securely.
And you just made me think about, here's another, as an investor, there's two things that could really, hamper your returns, right? One, you have some big repair, the foundation needs to be fixed, the new roof, there's water damage, there's bats in the attic. We have those in North Carolina. I don't know if there's frequent out there.
Nope.
So you can have some big repair. And so if you have extra equity, you're not really worried about it. You can just get the repair done quickly and keep your property rented. Another thing, which is going to be, it's very real right now, is just this rental, eviction moratorium. So like if you're a landlord with this product and all of a sudden your tenants can't pay or whatever ends up happening, your liquid equity is insulating you from any cash flow disruptions from your tenant. So that's amazing. And because in a traditional mortgage, if your tenant doesn't pay your rent, who's got to pay that mortgage? It's you. Right. Well, I'm still paying the mortgage with the all-in-one program. It sounds like I'm just using my own equity taking money from my right pocket, putting it in my left pocket to maintain my credit.
But yeah. And more importantly, 100% of what you put into it is principal reduction, not just a small portion of it. That's the key thing about this loan. We change the way your money is used into the loan. With a traditional loan, most of your payments are interest for really the first half of the mortgage term, right? So very little of your hard-earned money or your rental income is actually serving to benefit you more so than the lender or the bank. That's exactly the opposite in the all-in-one loan. It benefits you first. You actually become the bank of you. You're able to put in anything. If you put in $1 today into your all-in-one loan, your principal balance drops by $1. If you put in $10,000 today, your balance drops by $10,000. And then interest recomputes on that lower balance. All the meanwhile, your money's kept liquid. So it puts you in the driver's seat, not the lending institution.
Perfect segue, Dave. Perfect segue. So we're going to finish up on this. And we really appreciate you guys' time. We're going to finish up let's get in a little bit of the weeds here and let's dive in. You mentioned a little bit, some of the purposes of the loan, but tell us about a little bit more of the parameters that really need to be present to qualify for this loan. Is it geographic limitations? Could I only buy single family? Like what can I really use this for out there in the world?
To summarize, from a credit perspective, those with good credit profile, good ability to repay and demonstrated management skills of debt. So a 700 minimum FICO score typically is what we look for. So those with good credit, I think the average in America is somewhere between about 690 and 720 anyway. So average to good, to better credit scores. We can lend up to $2 million. There's no geographic restrictions. I'm glad you asked that question. There is no geographic restrictions on loan size on this loan. And we routinely go above and beyond $2 million and make exceptions all the way up to $3 million. It's a phenomenal product, especially for those, luxury, higher loan amount communities or geographic markets. Because in a conventional mortgage, you're limited, right? There's limitations with how much you can get. If you go over that limit, you can certainly obtain financing, but your interest rates and your pricing is entirely different. The structure, it's more expensive. Not on the all-in-one. It's there's no geographic restrictions or limits to where your loan becomes more expensive or you can't receive financing. So beyond that, we can generally finance up to 90% of a home's value or purchase price. So 10% down is the minimum for a primary residence. For a second home, we do require 20% down. For an investment property, we require 25% down. So even though this is a privately secured loan that we pioneered, we still do align ourselves with the industry norms, right? Industry standards, Fannie Mae, Freddie Mac norms in terms of the underwriting guidelines. However, we also add some features into it, Scott, that I think would be worth discussing real quick or highlighting. We can use this loan for delayed financing. So if there's a cash buyer out there who's liquidated some assets to win the contract, win that deal, win that home, but you're now stuck with, gosh, I'd like to liquidate those assets, put them back where they were. Well, you can use what's called delayed financing with the all-in-one loan and get back out up to 80% of the value or purchase price and recoup a large portion of the cash you utilize to make that purchase possible and take those funds right back out. We can take the application the day after that purchase closes without any seasoning requirement. So it's called delayed financing. The other cool thing about this loan is because it provides access to your home's equity dollars up to a credit limit. And again, our maximum is 90% on a primary residence. What if you had more than 10% down? What if you did have 20% down and you were prepared to do that? Well, on our loan, you could still come in with your 20%. So your initial loan balance is at the 80%, a lower loan amount level. So you're now reducing your exposure to interest, right? With money you had on hand and ready to put down towards a down payment, but you could still gain access to 10% up to that 90 with our loan. Wow. So you could retain access to a portion of your down payment, which is a phenomenal way to create some opportunity for people who have more than the minimum down payment available for that home purchase. Another key feature on this loan that I think is different from all other mortgages is that we can also use what's called asset depletion to help somebody qualify. So for self-employed, especially folks that, take advantage of tax laws and whatnot to reduce their tax liabilities, but don't really show a whole lot of income on their personal returns, but they have done a really good job of building assets. Well, we can utilize the value of those assets as income to help somebody qualify and get into this loan. It's a very aggressive formula or calculation that we utilize that really works out for suitable candidates. So a variety of different allowances that really make a lot of sense for people that know what they're doing with their money.
Perfect. So one real life way that I could see, my clients using this is a lot of times, if you have the cash and you want to really get that property you love and it's a multi-bidding, bidding war, this product, literally from what I understand, Dave, you can actually put an exuberant money down or buy it all in cash if you have the cash. And then afterwards, you can basically claw that cash back and bring that cash forward back to you. And what you're able to do is use your cash up front to leverage it to increase your viability and your overall market competitiveness of your offer. Get the deal, get in the driver's seat, and then delay the fine, and then pull your cash back out. And then maybe repeat it. Go buy some more property.
Yeah. A large portion of it, right? We not 100% of your down payment, but a large portion of up to a limit that we qualify the borrower at. And let me add to that too, real quick, and dovetail off of the point you're making. When you're a seller, right? One of the best ways to create leverage is by owing less on your mortgage. Think about it. If you owe less on your mortgage today, you can be a lot more competitive out there as a seller, right? And in a highly competitive marketplace. So this loan accelerates the reduction of your balance. So, for those people that are listening and are current homeowners who are thinking about potentially buying again soon, right? I think statistically about 20% of the housing market nationally starts thinking about buying again within 60 months of making a home purchase. So the one thing that impedes progress with doing that and achieving those goals is, again, the mortgage, because you make very little progress with the debt. And in fact, you have to rely almost exclusively on this fictitious thing we call home appreciation. And we're all concerned that, that we're in a bubble and that home values will maybe soften or come down in certain places. We could all argue that, both sides of that argument. I don't have a crystal ball, but what I do know is when you owe less on your mortgage and you're able to do that without changing your budget or your lifestyle and do it really rapidly, then that positions you better as a home seller as well.
Another, just the dovetail of that, Dave, another thing, like I have a lot of sellers who might come to me and, they have some cash, they have a lot of equity. But if they had a little bit more cash, say they had, the $40,000, they could have remodeled their kitchen, and that $40,000 kitchen all of a sudden could yield them $60,000 on the exit of selling that asset, that house.
Great point.
Yeah.
Great point.
If you're a seller thinking about selling in the next, number of months, it might make sense to go ahead and tap into this, product, get some of your equity, do the remodel rehab yourself, and get that extra. When you sell the house, there's no more opportunity to make money on it. So on the way out, stage left, you might as well maximize your return on investment by
such a strong point. Yeah, that's why you're in real estate, Scott. It's such a strong point. You're right. I mean, there are bidding wars. I mean, I'm out here in California, and I'm sure it's the same out there in your area. It is extremely competitive, and buyers are. It seems that buyers are willing to increase their offer by tens of thousands, in some cases even over $100,000, simply because they don't have to renovate the property they're buying. Right.
So. Headache? Just give me something I can move in my furniture.
Give me, turnkey. I can just move in and it's beautiful, right? So imagine as a current homeowner that's considering selling, in the next year or so, make that happen, make that possible. And you could do that through getting a more efficient mortgage, right? And so, great point.
Yep. Yeah, I think there's just, if I were to put a button on everything, Dave, just one pretty little bit, this is just all about flexibility and access to your money. And traditionally, banks haven't wanted you to have access to your money. They want you to be dependent on them on this 30-year mortgage. And when you really look at it, you're paying right now, what are rates? Low threes for 30-year fix. That's really, really good as a
face value. Sure. As an interest rate, right. Relative to where rates have been.
Yeah, but our absolute interest we pay, if you look at your amortization schedule, you'll probably get sick to your stomach because those first couple of years, you're paying 60 to 80% interest.
Yeah.
You don't believe me.
Well, let me put it this way. Yeah. You're right. On a 3% 30-year mortgage is equivalent to paying about $60 in interest for every $100 in principal you borrowed, in which most of that interest is going to be paid for up front. I don't think that's a good deal. 3% is a good mortgage rate versus 4% or 5%. I get it. But because of the way the loan is structured and how it applies your money, doesn't mean you're not paying a lot of money, a lot of interest, right? And that's why these things have been structured to bolster the bank system, create some dependable revenue in interest income for the lenders and bank system. It puts the consumer, us homeowners, back further and further and further. Is there any wonder why people are struggling to be able to afford retirement after their working years? And part of the problem is that they've carried a mortgage throughout their entire working life and they haven't been able to pay it down. This changes that entire paradigm, and it puts us before the banks.
It seems awfully fishy when you really start thinking about that banks front load the interest, right? We just said banks front load the interest. In the first 7 to 10 years, they get most of their interest. And that coincides directly with most homeowners start thinking about selling or buying another house after 5 to 7, 8 years. So if the average homeowner only has that mortgage for 7 years, that means they're perpetually not paying 3.25%. They're perpetually paying 60% interest. That's why we're doing this interview. And that's what we're here to do with you guys. Is we want you to know that if you went to the bank and they said, hey, we have two options. One that's going to take 30 years, you're going to pay 60% interest if they're going to be actually real with us. Or you have this other option, you can get it paid off, same cash flow, and 2 to 4 times faster without sacrificing liquidity. If you were really presented that option, no one would actually select the 30-year illiquid risky option. It wouldn't even exist. So, all right, guys, well, that pretty much about wraps it up. I really want to say thank you for taking the time. I know you guys are very, very busy out there. This is just so important, near and dear to my heart. I'm just absolutely passionate about homeowners having access to their equity. It's your money. You should have access to it with your money. The world is your oyster. So many more options and flexibility. And I just think it's a travesty that not every single homeowner in America knows about this. I mean, this is literally the most innovative aspect to hit the mortgage industry in the last 80 plus years. So thank you for taking the time. If you want to learn more, down the webpage, there's a little form, just fill it out. We'll have a qualified, dedicated all-in-one specialist give you a call and see, what's possible for you. And also there's a couple of questions about real estate. If you get access to a bunch of your equity and want to talk more about investing and how you can build wealth through real estate, we'd love an opportunity to help you out with that too. So thanks again, Dave, for your time. I really appreciate you. And we look forward to continue working together.
Yeah, absolutely, Scott. Thank you so much for doing this. Powerful.
All right. Take care, guys. Bye-bye.